We are the Group 6 and we're going to discuss what is production, what is cost, and what are the structures of industry. The Group 6 members was composed by Lelaine Garcia, Mike Leandros Pares, Dante Cabral, and Norlam Cruz, John Celedonio, and Reynalyn Conge. What is production?
Production refers to the transformation of inputs into outputs or products. Input. An input is a resource that a firm uses in its production process for the purpose of creating a goods or service. A production function indicates the highest output that a firm can produce for every specified combination of inputs, physical relationship between inputs and output, while holding technology constant at some predetermined state. Mathematically, we represent a firm's production function as Q is equal to F over L and K, assuming that the firm produces only one type of output with two inputs, labor represent L and the capital represent K. The quantity of outputs is in a function of or depend on the quantity of labor and capital used in production. Output. Output refers to the number of units of the commodity produced. Labor. Labor refers to the number of workers employed. Capital. Capital refers to the amount of the equipment used in production. We assume that all units of L and K are homogeneous or identical. Technology is assumed to remain constant during the period of the analysis. Why is theory of production is important? The theory of production plays a vital role in the price theory. It provides a base for the firm's demand for factors of production, which together with their corresponding supplies determine the prices of the factors. These supplies together with demand plays an important role in fixing the price of the product. And these are the factors of production. Factors of production are the input available to supply goods and services in an economy. Land, natural resources available for production. Labor, the human input into the production process. Enterprise, entrepreneur organized factors of production and take risks. Capital, good use in the supply of others' products. Factors of production are the resources people use to produce goods and services. They are the building blocks of the economy. Economists divide the factors of production into four categories: land, labor, capital, and entrepreneurship. In economics, factors of production, resources, or inputs are what is used in the production process to produce output, that is, finished goods and services. The utilized amounts of the various inputs determine the quantity of output according to the relationship called the production function.
What is cost?
What is cost in a business? In business and accounting, cost is the monetary value that a company has spent in order to produce something. Costs are the amounts that a business incurs in order to make goods or provide services. Notes the amount of money that a company spends on the creation or production of goods or services. It does not include the markup for profit. Cost in accounting. In accounting, the term cost refers to the monetary value of expenditures for raw materials, equipment, supplies, services, labor, products, etc. It is an amount that is recorded as an expense in bookkeeping records.
What is cost from seller's point of view?
From a seller's point of view, cost is the amount of money that is spent to produce a good or product. If a producer were to sell his products at the production price, his cost and income would break even, meaning that he would not lose money on the sales, however, he would not make a profit. What is cost from a buyer's point of view? From a buyer's point of view, the cost of a product is also known as the price. This is the amount that the seller charges for a product, and it includes both the production cost and the markup, which is added by the seller in order to make a profit.
Why cost is important in a business?
Costs are important to business because they are the thing that drains away the profits made by a business. The second one is they are the difference between making a good and a poor profit. The third one, they are the main cause of cash flow problems in business. And the last one is they are the change as the output or activity of a business changes.
What is cost production? Cost of production refers to the total cost incurred by a business to produce a specific quantity of a product or offer a service. Types of cost of production. Number 1. Fixed costs. Fixed costs are expenses that do not change with the amount of output produced. This means that the costs remain unchanged even when there is zero production or when the business has reached its maximum production capacity. Number 2. Variable costs. Variable costs are costs that change with the changes in the level of production. That is, they rise as the production volume increases and decrease as the production volume decreases. If the production volume is zero, then no variable costs are incurred. Number 3. Total cost. Total cost encompasses both variable and fixed costs. It takes into account all the costs incurred in the production process or when offering a service. Number 4. Average cost. The average cost refers to the total cost of production divided by the number of units produced. It can also be obtained by summing the average variable cost and the average fixed cost. Number 5. Marginal cost. Marginal cost is the cost of producing one additional unit of output. It shows the increase in total cost coming from the production of one more product unit. Since fixed costs remain constant regardless of any increase in output, marginal cost is mainly affected by changes in variable costs. How to calculate the cost? The first step when calculating the cost involving in making a product is to determine the fixed cost. The next step is to determine the variable cost incurred in the production process. Then add the fixed cost and variable costs and divide the total cost by the number of items produced to get the average cost per unit. This table, as you can see, in the first column is the output. In the second column is variable cost, which is already given, and the third column is the fixed cost. In 1 unit producing $10 and 2 unit producing $10 and 3 unit is $10 and why? Because it's a fixed cost. To solve a total cost, just add variable cost and fixed cost. 0 plus 10 is equal to $10. $15 plus $10 is equal to $25. $27 plus $10 is equal to $37. $35 plus $10 is equal to $45. $45 plus $10 is equal to $55. $70 plus $10 is equal to $80. $130 plus $10 is equal to $140. To get the marginal cost, minus 10 to 25 to get 15. 25 minus 37 to get 12. 37 minus 45 minus 55 to get 10. 55 minus 80 to get 25. And the last is 80 minus 140 to get 60.
Market structure is best defined as the organizational and the other characteristic of a market. The elements of market structure include the number and size distribution of firms, entry condition, and the extent of differentiation. There are four types of market structure. The first one is monopoly. It's a market structure in which there's only one producer-seller for a product, the single business in the industry. Entry into such a market is restricted due to high costs or other impediments which may be economic, social, or political. The second type is oligopoly. There are only few firms that make up an industry. This select group of firms has control over the price. The products that the oligopolistic firm produce are often nearly identical, and therefore, the companies which are competing for a market shares are interdependent as a result of market forces. The third type is perfect competition. It's characterized by many buyers and sellers, many products that are similar in nature, and as a result, many substitutes. There are few, if any, buyers to entry for new companies, and prices are determined by supply and demand. Procedures in a perfectly competitive market are subject to the prices determined by the market and do not have any leverage. The last type is monopolistic competition. It's a type of imperfect competition such that one or two producers sell products that are differentiated from one another as goods but not perfect substitutes. A firm takes the price charged by its rivals as given and ignores the impact of its own prices on the prices of other firms.
Oligopoly control infrastructure. An oligopoly structure occurs when a few small businesses dominate the industry and collude with another to bar another companies from competing in the industry. In many instances, businesses involved in an oligopoly have control over the resources, technology, and raw materials necessary for success in that industry. An example of oligopoly is the petroleum industry, where a few companies control the output and can raise prices to boost profit margins. Monopoly control elements. In a monopoly, one business controls the industry. Any buyer interested in that specific product, service, or goods must buy from or engage in that business. This infrastructure is the opposite of the perfect competition infrastructure because there are no competition in the industry. Major League Baseball is an example of a monopoly because baseball players who want to play professionally in the US and be paid the high salary can only play with MLB. We are the example of a perfect competition. Lovejoy Sari-Sari Store, Maris Karinderia, Paulo Paris-Paris, Charles Famous Pare-Pare, Maxis Bonche. These are the example of monopolistic competition. McDonald's, Burger King, Jollibee, Nike, and Adidas. Isuzu Motors, Mitsubishi Motors, Ford Motors, Nissan Motors, Delta Motors are the oligopoly examples. And the monopoly examples are Meralco, PLDT, Maynilad, Microsoft, and Facebook.